Welcome to the Global Investing Podcast. I'm talking to Jay Kothari of DSP Mutual Fund,
the DSP Global Equity Fund, which is going to be operating in GIFT City.
On the eve of the launch of India's first ever retail mutual fund in GIFT City.
We're going to be investing in 5 major markets, which includes the US, Europe, Asia in general, Hong Kong, Japan, and Korea.
It's quite substantial because if the rupee does depreciate by 4% per year, we're looking at a 16% kind of rupee return. Of course, it's a big if because Donald Trump has changed the math on the US. Welcome to the Global Investing Podcast. I'm your host, Neil Borate, and I'm talking to Jay Kothari of DSP Mutual Fund on the eve of the launch of India's first ever retail mutual fund in GIFT City. It's a retail outbound fund. And the reason why this is so important is because since 2022, domestic mutual funds had trouble investing fresh money outside. RBI limit has been hit for the industry overall. And so you have very limited room for domestic mutual funds. And so GIFT is the solution. And for the longest time, we only had AIFs in GIFT City with a minimum ticket size of $1.5 lakh. Now we finally have a retail fund that you and I can participate in with a minimum ticket size of just $5,000. So first of all, Jay, congratulations.
Thank you, Neil, and thanks for having me.
Great to have you here. So if you can quickly run us through the investment strategy of this fund.
Sure, absolutely. Just before that, I'll take a step back and give you a quick introduction about how we are placed in the GIFT City. So we started operations in 2023. We launched our first fund in 2024. And currently, DSP is the largest AIF Category 3 fund in the GIFT City ecosystem. So this was all inbound, but as you rightly mentioned, this is going to be the first outbound retail fund. So there are a couple of AIFs, but this kind of gives a opportunity for retail investors to look at the global markets, and we've done it on the active side. So a lot of people may be thinking even from a passive side, nothing wrong with it, but we feel that this could be a good opportunity, and we wanted to do it more on an active basis because we have two gentlemen at our end, Natraj and Jayesh, who've done global investing in the past. We also have our broader equity team, which looks at global stocks, including our risk and quantitative analytics. So we have the value fund and the other couple of funds which have looked at global stocks. So this was a good breeding ground for us to look at the globe. And just to give you a sense in terms of what we're trying to do here is that contrary to what you see in terms of global funds, usually they are benchmarked to the all country world index. That's the MSCI ACWI, which people tend to follow. Again, nothing wrong with it, but we felt that we wanted to do slightly a rule-based kind of investing and say only go with the ACWI. So we wanted to make it slightly more active. So we have kept the benchmark slightly agnostic. We're going to be investing in 5 major markets, which includes the US, Europe, Asia in general, Hong Kong, Japan, and Korea. In a way, this is going to be filtering from the 3,000-4,000 stocks which are listed globally. So we have a cap of around $30 billion is the threshold we generally will look at in terms of the companies, which give us those.
So only above that market cap would you invest?
Yeah, predominantly. It's not that we won't go below that, but there's nothing scientific about $30 billion, but we just felt that gives us scales, and that also covers almost 55-60% of the all country world. So we're doing that. So the idea is going to be identifying the 300-400 stocks which kind of get filtered, and within that, if we're able to find the top 25-30 names with a concentration, that's going to be our focus to invest across the world.
Interesting. If you can give us the criteria though, do you have like an ROC or a set of parameters on which you will select?
Absolutely, yeah, and that was the logical next step in terms of thinking that what kind of returns would excite us. So generally not having a benchmark bias, which is a good thing. We felt a 12 to 13% kind of a gross dollar return is something which we would want to go with. And this is a mix of both ROE or earnings growth rather. Of course, ROEs are extremely important, which gives you that kind of output in terms of the earnings growth. So earnings growth of 7-8% plus plus the 2-3% in terms of the shareholder yield, which is dividend plus buybacks. So generally, looking at 11-12% dollar return is something which we will want to focus
that's
on.
quite substantial, because if the rupee does depreciate by 4% per year, then we're looking at a 16% kind of rupee return. Of course, it's a big if, because Donald Trump has changed the math on the US.
Correct.
But if that happens, it will help.
Absolutely. But just on that point, we are very balanced in that sense that it can go the other way also, that if rupee appreciates on the other side, you may land up. So that could be one of the risks from overall return perspective. However, I think investors should look at the absolute kind of underlying investments rather than the Forex, which is not going to be in our control anyway.
And also for you, US market is going to be just one share of it, right? What percentage would it be?
Sure. So ACWI has around 65%. We'll be having around 30%. So in a nutshell, it's going to be underweight US, overweight all the other markets, whether it's Korea, Europe, Japan. So we're going to be, so Asia in general. So that's going to be an overweight. And underweight on the US, because similar to India, because a lot of Indian stocks and sectors are seeming slightly more punchy in terms of their valuations. US is going through its own similar kind of valuation issue. So we feel that this could be a good mix to take exposure.
Sure. Now I'll come to a question that I think a lot of people have asked in the past, which is that, Indian AMCs are good with Indian markets. Why are Indian AMCs going to be good with global markets?
Correct, and that's a question which we ask ourselves as well. So, but the simple answer is that investing in companies across the world remains the same. So you look at ROEs, to your questions you asked, you look at profitability, you look at growth, you look at earnings, you look at valuations, and our general sense is going to be looking at global stocks in a similar lens. What we look at Indian stocks, we look at the ROEs, earnings growth, and the idea is to invest into companies on a bottom-up basis. We're not going to be looking at that, pick up the best sector across the world and then invest, top-down. So we believe that global capital is going to go into passive and active. Within active, if you just flip the question around, even in the US or Europe, there are active managers who are in that market. Still, they have tended to underperform. But the point is that they, of course, put money to work.
Now, let me come to the taxation of the fund, because here you have fund level taxation, and it's not a concept that Indian mutual fund investors are familiar with.
Yes.
So just to explain to our viewers my understanding of the subject, and then Jay can correct me or add to it. So fund level taxation means that if the fund has a churn and within 2 years it buys and sells stocks, it books some profit, the fund will deduct a tax at 42%, including surcharge and cess, on that short-term capital gain. And after 2 years, if it does some churn, then it'll deduct tax at around 15%, because 12.5% plus surcharge and cess. So it's in the interest of the fund and of us, the investors, that the fund minimizes churn at least in the first 2 years. And therefore, since the fund is deducting the tax, then you as the end investor, you do not pay any tax. You can report it in the exempt section of your ITR. And even more importantly, because GIFT City is within India for income tax purposes, these holdings don't have to come into Schedule FA, and you are spared the risk of misreporting Schedule FA and the risk of something as rigorous as the Black Money Act. So that's, I think, a big draw, big powerful reason to invest through GIFT City.
Yeah.
But Jay, I think one point of confusion for a lot of people would be that, in their heads, they know India taxation, that 2 years ke pehle agar nikala to, slab rate after 2 years. But here it's actually fund level. So
correct.
If you could just clarify, let's say the fund has not booked any profits, but I am exiting before 2 years.
Right.
Still, the NAV that you will give me will be net of 42%.
So, in terms of giving you an example, that when we buy and sell mutual funds in India, you'll end up paying the taxes at your, when your CA asks you the year-end profit and loss, and then the tax is kind of levied on that. Here, you don't have to do that, because your returns are X of or net of the taxes which the fund already pays. To your question that, if you land up redeeming before 2 years or after 2 years, whatever the case may be, the churning has to happen at the fund level. So if Nataraj and Jayesh, if there's a redemption, so let's assume there is a $100 million fund and there is a 20 million redemption, then on the 20 million, based on whether it's the short term or the long term, 45% or 15% respectively will be levied on the fund at large, and therefore proportionately to the unit holders. And then what you get is net of that, which also means is if the fund is large and if there's a very minor redemption which happens, which forces the manager to redeem, maybe the net impact, even as far as tax, is not going to be as large as 42%, which kind of,
So just for example, if you have 5% cash and just 5% investors redeem, you may not have to sell anything to meet those redemptions.
And we are very conscious of kind of sticking to our stocks from a long-term point of view if we are comfortable with the valuations, if the still thesis continues. And we are conscious that, if I am going to sell the stock, which is going to get a 50% or 45% tax, and my downside of the stock is less than 20%, why would I do that? So I might as well kind of hold on to the stock. So we are conscious that we are going to be keeping the churn to the minimum, unless there's a corporate governance issue or there's some kind of unforeseen circumstances which forces us to sell, then we will of course do our job. But otherwise the idea is to remain as tax efficient as possible.
And also to discourage exits, you do have an exit load of 1%
for the first 12 months.
For the first 12 months.
Yes.
I wonder though if it's enough, because let's say that I know 2 years are going to complete since the launch of this fund. One day before those 2 years complete, I buy the fund, and then the NAV jumps up massively because holdings have completed that period. So I benefit from that. Correct. And the third day I exit at a 12.5% tax rate. So to discourage that, would you have a higher exit load? How do you deal with that?
No, I think it's all got to do with the intent of the investor. So if they need the money, so 12 month is a good discipline to have. You can have it 2 years. There is no kind of debate on that. But we just felt that 12 month is a good enough kind of holding period. And after that, it's about the asset allocation. If you want to continue, you will continue. We would like to believe that investors are going to take more a holistic investment call and not necessarily only just a tax call. Because as I mentioned even at the start of the discussion, is that the underlying investments are going to be more important than actually the overall impact of the taxes, because that is going to be a derivative of when you buy and sell.
Okay, let's come to the process of investing.
Sure.
My KYC is done in India.
Yeah.
Is that valid in GIFT City?
Firstly, the regulators are extremely proactive, so we're trying to find ways how to kind of, to answer your question, you have to do your KYC even at GIFT level. But the good part is that since you have the KYCs ready from a mainland India point of view, if you're able to kind of use technology or the NOCs to port this KYC onto the GIFT ecosystem, that is the best way to do it. So we are trying to do this entire process on a digital ecosystem, from KYCs to digital onboarding to digital kind of applications to the transfers and then the A2 forms, because there are a couple of complexities in terms of the physical kind of, you take a printout, then you send it to your bank, then they send it to DSP and so on and so forth. So we're trying to kind of limit that. But for people who are still not comfortable with digital, we will have the physical kind of route as well, which is slightly cumbersome, but at least it's not the end of the road.
Okay, so short answer is currently physical, I have to do it again, but you will soon digitize it.
Certainly. That's the way you can kind of ease of doing business.
So it'll be a video KYC, I'll have to probably just give my PAN and Aadhaar and
correct. So we are kind of triggering that, and I think a lot of vendors, partners are kind of working in that. So there will be a lot of partnerships, and I think we'll proceed digitally.
Yeah. Now let's come to distribution.
Sure.
So if I'm a mutual fund distributor in India, can I distribute your fund?
The answer is you can't distribute the fund if you're not registered with the GIFT ecosystem. So in this case, DSP is the fund management entity, FME. So we kind of make the distributors onboarded, we do the KYCs. So from an IFSCA point of view, we are the representatives who have got the IFAs, even if they're registered with the SEBI registered or the AMFI registration. But that's not enough. They have to follow the code of conduct, they have to follow the KYCs, and then they kind of get onboarded, and then they are allowed to kind of sell those strategies.
Can I do an SIP in the fund?
You can, but it will follow the process in terms of investing across. But there are a few platforms which are going to have those facilities. So I think you should expect that very shortly.
All right. Anything else you'd like to say before we conclude?
No, I think this is yet another global opportunity, and on the retail side, and generally global investors and even Indian investors want to look out across the world. So this is an opportunity for even the retail investor within India to taste the global exposure, whether it's on the IT side, tech side, healthcare, consumer brands, etc., which is not available in India.
For investors to visualize what kind of stocks will be in the fund, could you give us a couple of names or?
Yeah, I mean, so we've heard of Nike and Adidas and Eli Lilly, and there are a couple of tech companies. There are a couple of consumer companies in Europe. There are so many EVs which are kind of coming up, and these are plays which you don't get in India. So whether it's in the US, you've heard of the FANGs. So it will have a mix of your consumers, your pharma, your innovative tech, your healthcare, and so on and so forth. So it's going to be a mix of great companies.
Final question: can NRIs invest?
They can, but I think what we are also trying to do is that there is another structure which could be created where if there is 100% offshore capital coming into the strategy, they are not subjected to the capital gains which we spoke about. So the technical answer, yes, they can invest. Is it going to be absolutely tax efficient for them coming from all jurisdictions? Probably not. And hence, maybe in the future, we kind of create another platform which allows global investors to come in, which are not taxed. Here, we are getting taxed because Indian investors are also investing.
Fantastic. Thank you so much, Jay.
Great. Thank you. Thanks for having me. Thank you, Neil.